Hello, hello. In this video, we're going to talk about Meta. The company has been completely devastated in the past few months. It's actually down 66% from its one-year high, which is insane for a company of this caliber. And it was up yesterday about 5%. And there is a reason for this. We're going to examine it in the video and also talk about some other news around Meta. And of course, we're going to examine the financials as well, what we usually do, because we want to see whether Meta is actually a good buy right now or we should abstain. We should actually wait for a better opportunity potentially. We'll see. Now, Meta is one of my holdings and a big holding of mine, and my cost basis is 158, which when I bought, at the time I bought, I thought it was insanely low. And imagine we got even lower. But okay, let's examine what is going on with this company. Now, the first thing, US lawmakers unveil bipartisan bid to ban China's TikTok. And as you can understand, TikTok is a competitor. Now, it's not a massive competitor, not as much as the media wants to portray. They are making just a fraction of what Facebook is or Meta is actually making in their earnings. Yet they are a player, and they're getting better and better. So if this application TikTok basically gets banned in the US, this is gonna be a big thing for Facebook. Of course, it's gonna help it on, grab a mass amount of advertisers instead of TikTok getting them, and also. Google is going to be affected by this in a positive manner, of course. Okay, so the legislation to ban China's popular social media app TikTok, ratcheting up pressure on owner ByteDance Limited. Amid the US fears, the app could be used to spy on Americans and censor content. And I was taking a look at the terms of service of TikTok, which are insane. They basically really promote espionage, and pretty much the amount of spying over there is insane. Now, I'm not saying that other applications don't have similar amounts of spying, but the weird thing about TikTok is that it was part of their terms of service. And actually, even a video from Joe Rogan, where Joe Rogan himself was actually talking about TikTok, was fascinating. I'm going to link that in the description box below this video in case you're interested in watching that after this video, because I think it's pretty interesting to see. Now, the legislation would block all transactions from any social media company in or under the influence of China and Russia, is what they said, adding that the companion bill in the US House of Representatives was sponsored by Republican congressman, whatever. Okay, so this is an interesting thing here, of course, and again, if this happens, this is going to be a good thing for Meta. And another news of the day is the fact that the Ethiopian lawsuit against Facebook owner seeks $1.6 billion, in a pretty high amount over here. And as you'll see, two Ethiopians have filed a lawsuit against Facebook's parent company Meta, of course, over hate speech they say was allowed and even promoted on the social media platform, pretty much amid the country's deadly Tigray conflict. So I doubt this is going to go through, frankly, but you never know. So if that happens, Meta could potentially pay some amount. I don't think this is going to be anywhere near 1.6 billion, but who knows? Maybe. So it's worth noting at least. Now let's go back to the actual financials of the company. As I mentioned in previous videos, the P ratio and the price to free cash flow of Meta is, one is better than the other, really, though. So they're competing on which one is better than the other. And the P ratio is extremely low, but take a look at the price to free cash flow ratio. It's even lower. Absolutely insane over here after the adjustments for free cash flow. Of course, because of the amount that is getting added back to the free cash flow due to stock-based compensation, for example. It's going to be a big one. And outstanding shares pretty much getting bought, and Meta has announced that they are going to be buying more in the future. So this becomes a company that not only is very cheap right now, but it's going to get cheaper in the future, at least based on its current price right now, because it's going to be buying back shares, pretty much retiring these shares. So it's going to be, almost impossible for this company to stay at $100, frankly, in the upcoming years, to tell you the truth, unless something radical happens, which I don't even know what that would be. But total liabilities to free cash flow are sitting at 1 year, basically 1 year of free cash flow to pay back all the total liabilities that the company has. A very solvent company. And Take a look at the revenue growth, net income growth, free cash flow, total equity. All of these are going upwards and significantly so. Now, we do know that maybe in the next year or so, maybe even 2 years, who knows, there's going to be some sort of decline in the revenue growth that the company has been achieving, and similarly, possibly a decline in net income and free cash flow. So there may be some slight decline, which is already priced in, of course. I mean, we know about these things and we know what analysts are talking about. Now, will that happen? I'm not sure. It really depends on politics, I should say, for the most part. Because otherwise, this company is supposed to continue growing at a fantastic rate over here. Yet, being down 66% at this price and at some point even lower, again, if you take a look at the 1 month chart, you will see where it actually, at some point over here, was like $90, for instance, in the last month. Insane, right? So it was very, very cheap. And right now, sitting at 120, I still think it's insanely cheap, frankly. But okay, let's examine the finer details here. Of course, this is a company that is making great margins as well. Slightly lower, of course, they have gone lower because, again, of the issues that the whole economy pretty much has been having. But overall, they are making very, very high margins, 30%, 35%. Again, right now it's going to be a little lower, but still 24%. It's very, very high. And the debt-to-equity ratio is almost negligible. It's just not there. There's no debt for this company. And the returns are fairly normal and nice here. In terms of the financial statements, we always want to examine these finer details here. And it's a story of a company that is growing everything. Again, 40, 55, 70, 85, $118 billion for the past 5 fiscal years. And in terms of the net income, 15, 22, 18, 29, and 39 over here. Again, growing their net income at an incredible pace, pretty much almost tripling that in the last 5 years. In terms of the balance sheet, you will see that the total equity of the company from $74 billion to $125 billion, an insane amount, pretty much, that the company has managed to accumulate in terms of its total equity. And they have about $41 billion in total liabilities, which, as you can understand, is very little if you account for the fact that the company is making almost $40 billion. The amount of liabilities, pretty much, they are making it in a single year in free cash flow. Insane. And remember, they're starting with 39.3 billion over here in terms of net income. There are some adjustments because the company is paying employees with stock. Of course, a lot of Bay Area companies do that, most tech companies. And depreciation amortization also gets added back, understandably so. And these are about $16 billion, which effectively make the net cash from operating activities, that's the operating cash flow, at about $58 billion. They take it to $58 billion. The capital expenditures, again, also increasing, understandably so, again, for the company. But remember, we have the issue with what is going to be happening with the metaverse. The metaverse has been a big thing, a big thorn, pretty much, for Meta, for Facebook. And this has pretty much played the biggest role in taking the company down that much. Because it hasn't been profitable yet. Very few people have adopted it. And frankly, it looks terrible, so far at least. I don't know what's going to be happening in the future, but for the amount of money that has been spent, this doesn't make sense. It's looking really, really bad in terms of how it's performing, how its visuals are. I don't know what's going to happen in the future, but it doesn't look bright. And I hope that at some point they will either abandon or at least spend much, much less than what they are currently spending on this project. It's the biggest thorn here in terms of the company's progress. Otherwise, I think this is a fantastic company. But even if that completely fails over the years, I think it's going to be a forgotten thing, and the company will go back to its growth. So yeah, it is a company that I'm more than happy to accumulate more stock of for the upcoming years. And you will see here that the cash that they have at hand in fiscal year 2021, about $17 billion. Now, we will examine our stock evaluation tool, our stock evaluator, the discounted cash flow model, and the revenue growth, 34, 28, 37. Now, we do expect that the company's revenue growth is going to decline in the next 5 years. So I'm going to go 8, 10, and 12. And of course, if you have access to the tool, you can try your own projections over here. If you're interested in getting access to this tool, you can become a Patreon. The link is in the description box below this video. You can try everything you want here for all sorts of different stocks. And net income margins, again, they have been going down for the fiscal year. So the past few quarters have been going a little bit down. Again, it was like 25%. if you take a look at the margins for the year, they are higher. But again, if the margins that we're getting from our tool, the graph that we saw earlier, are actually showing us the margins for the latest quarters. So these are down a little bit. Hence, I will go a little bit lower, but not that much, because I don't anticipate that these lower margins are going to stay for a long time. So I will go 26, 28, and 30 here. And the free cash flow margins, typically company around 180, 90, and 100, very typical. So this is what they're doing, and this is what I'm going for. 13% for our annual potential annual return, the amount of money that we want to be making every year. Hit calculate, and we are getting obviously a value that is actually way, way better than the current price. So it would make a ton of sense to be buying a Meta today for 170 bucks. It would be cheap. Even at 200 bucks, it would be cheap. But currently, the current price is 120, and it used to be even less than 100, which is insane, frankly. And so if you don't really care about what is happening right now, and you don't really pay much attention to the sentiment, I think this is a fantastic opportunity. As I've mentioned in previous videos, even if you have a 0% revenue growth for all cases over here, you will see that we are still getting a buy. This is still a buy, not growing at all for the upcoming 5 years, like 0% growth. It's still a buy. So yeah, understandably, this is a fantastic company to be adding to your portfolio. And again, if you are not, very, I should say, afraid, scared of what is going on with the metaverse, and you think that this is going to be a temporary thing, as I think it's going to be, again, it could last for a while, and it could completely fail. But again, if you're buying this for the next 5 years, 10 years, for some years to come, I think this is going to be a pretty big winner. And I do expect that it would, easily surpass 500 bucks or so at some point in the future, maybe in the next 5 years or so. That's what I think. I could be wrong, but we'll see. Hopefully, we'll be around to witness that. But do tell me what you think about Meta, whether you own it or not, whether you are waiting for a better price, or whether you bought it pretty much lately. Leave a comment below. I'd love to hear your opinions, and I'll see you in the next video. Thanks for watching. Bye bye.